As widely expected, the U.S. Federal Reserve held its overnight rate steady following 3 consecutive cuts. Joining me now with more is Scott Colbourn of TD Asset Management. Scott, this is the Fed's first policy meeting of the year, but there's no mention of the risks from Trump's tariffs. Was this a bit of a surprise to you?
For the market, this wasn't a surprise meeting. As you said, no rate movement was expected. They basically, came out and made some mild adjustments to the first paragraph of their statement, basically marking to market the data and the statement together. So they took out, references to a cooling labor market or an easing labor market, and basically said, the labor market remains, steady, and they made some adjustments to inflation. At the margin, the first read of this is slightly hawkish, but they did reference the fact that inflation remains somewhat elevated. I think from a point of view of tremendous uncertainty as far as policy goes over the next few months, the Fed just wanted to steer away from that and see what comes over the next few months.
And now we've also heard from President Donald Trump, who is making it clear that he wants interest rates to come down immediately. What effect can the president have on the future path of monetary policy?
Chairman Powell addressed that right head on. Look, at the end of the day, the Fed and the governors serve the public, and they strive to make progress towards the inflation goal and the labor market goal, and again, try to steer away from any conflict with President Trump, who is entitled to say what he wants to say.
All right, and now the Fed didn't release the new dot plots, but in December, officials did say that they expect just 2 rate cuts in 2025. That's down from the previous 4. Has your view on the outlook of interest rates changed?
We got the marking to market in December in sort of a slightly more hawkish Fed statement, which said, look, the forecasts were for 2 cuts in 2025. At this point, we don't get a new forecast until March. And at that time, the Fed is going to have to incorporate some of the policy statements that the administration is trying to achieve. At this time, it's best to leave all options on the table. The Fed wants its optionality to address an economy, which I think is in pretty good shape, right? The labor market, we had a little bit of a scare last year, and it's stabilized. We've got inflation making its progress. Maybe the last mile is a little bit more sticky. So we're in a pretty good sort of Goldilocks scenario. The Fed has indicated its bias. I would lean towards that as well, that we probably, all things considered, will see more further progress on inflation, and then we may get rate cuts. But look, options need to be open here, given tremendous uncertainty as towards policy from the administration.
Okay, so let's talk a little bit about the bond market, because we have seen 10-year Treasury yields have increased since the Fed started cutting rates back in September. What's driving this recent rate increases, and what's it telling us about the path forward for interest rates?
When the Fed did their 50 basis point cut, there was that concern, and we've seen the adjustments in the statement. There was a genuine concern about the labor market cooling more than the Fed wanted it to, and they had seen a lot of progress on inflation. So Fed felt comfortable. Since that time, the data has come in. We've seen good progress on the labor market stabilizing, inflation okay, and the capital markets have done a good job. So yeah, we've seen an adjustment upwards in yield. Maybe there's a little bit of a concern about fiscal and the uncertainty on that side. So maybe a bit of term premium has been built in, but net, I think we're still in a fairly balanced position. We've seen rates stabilize of late. So net, I think we're in a good position. There's good opportunities in the fixed income market. I think that we're left with the Fed with lots of options on its tables to address anything going forward here.
Okay, let's talk about the U.S. dollar, because there's been concerns about widespread U.S. trade tariffs. That has benefited the U.S. dollar versus its peers. What impact could the Fed's reluctance to cut interest rates more aggressively have on the U.S. dollar performance going forward?
Look, the dollar has really outperformed. The U.S. exceptionalism has been a huge tailwind. Maybe we're starting to see elements of cracks in that. With the adjustments that have gone on in the AI exceptionalism model, perhaps. I think we're going to see a Fed that wants to cut rates if it gets the opportunity with the inflation market. So maybe at the margin, we're going to see a little bit of softening in the U.S. dollar tailwind here. But net, I'm not going to, to get really aggressive on that front. We're going to see, potential surprises here in Canada and Mexico, Feb 1st. What comes on the table, and that could be a real headwind for both the Mexican peso and the Canadian dollar.
Okay, and looking ahead, what are some of the indicators that you'll be watching closely as the Fed considers its next move? I would assume tariffs will be number one on the list.
When I say policy, we all go centrally to tariffs, right? So, but there's huge, we've got immigration potential, regulation, fiscal policy. Obviously, tariffs matter. So there's a lot of quote unquote policy challenges that we're going to be all looking for. So the Fed is data dependent. The market is highly data dependent. Is it Trump dependent? Is policy dependent for sure. And so, that degree of uncertainty is, unsettling to the markets at the margin, and we'd all want some clarity. But this is what we have to deal with right now as participants.
Scott, thank you very much for your time.
My pleasure. Thanks, Anthony.